In the next financial crisis, we are going to see Federal Reserve backstopping the alternative investment funds and private credit funds, because otherwise the spillover into the banking system is going to be too huge to be contained. I do really strongly believe that we have to expect and we have to be prepared for the Fed to act as the lender or credit provider of last resort to alternative investment funds, not just the public one, but the private one. And I think we should become comfortable with that, because that's where the financial system is going. And that's where the Fed is going to be in the next financial crisis.
3, 2, 1. I am very pleased to welcome to Monetary Matters Elham Saeidinezhad, Term Assistant Professor of Economics at Barnard College and the Market Structure Fellow at the Jain Family Institute. Elham, great to see you. Welcome to Monetary Matters.
Thank you, Jack. Thank you for having me. And Monetary Matters and your podcast has always been one of my favorites. So it's a pleasure to be here and look forward to our conversation today.
I am so glad you're here, Elham. You've got a paper that's about to be out, the title of which is Banks as Synthetic Hedge Funds. Tell us what this paper is about, what motivated it, and what were your key findings?
Sure. Thank you. Yeah, this is a working paper, but yeah, the first version is going to be out soon. So basically, the idea is that after the collapse of SVB, there has been so many discussion about why
Silicon Valley
SVB
Bank,
has
sorry, yeah.
Yes, exactly. After the collapse of Silicon Valley Bank, so there has been so many conversation about like why the bank has failed and why we saw kind of like a cascade of failures after that. And one of the narratives, and there are so many things that was said, and I found them very constructive. But one of the narrative that I really wanted to kind of like push back was that they were, like it was all the problem of like poor risk management. So this was a really, really traditional bank. So it was a little bit too good of a bank, because there was some accounting problem with the way they were recognizing their U.S. Treasury holdings. But what they were doing at the end of the day was a very traditional banking of investing in a very safe fixed income asset. And then they had interest rate swap, but at the time of failure, they did not have an interest rate swap, just because kind of like and that was the only fatal failure they had, because it was a poor risk management. At some point, they were trying to properly manage their risk. For some reason, because of poor risk management, they kind of like dropped that, and then that was the reason that they collapsed. So it was a traditional bank with a very poor risk management. So this is one of those things that I wanted to kind of like push back against and say that, well, when you look at the balance sheet of the Silicon Valley Bank, not from a banking perspective, but from the IO or industrial organization or the business model of a hedge fund, you will see that some of their actions or decisions when it came to the holding of interest rate swap and the holding of U.S. Treasury was not really based on this narrative that they wanted to be a traditional bank, but they actually were acting like a hedge fund that wants to execute like a fixed income arbitrage strategy. And the problem then was that, and we can talk about it later, that they were not behaving as they weren't a very good hedge fund, but nonetheless, what they wanted to be was to be a hedge fund rather than a good bank. That at some point they were tempted, and they decided not to do proper risk management. So this is actually their behavior can be explained if we listen to them carefully regarding their narrative about the shape of term structure and how that narrative is affecting their decision in terms of like managing their holding of U.S. Treasury and interest rate swap. So I'm gonna pause here because I know that we are going into more details, but basically my idea is the risk management story is not a very good story for understanding how SVB has managed an interest rate swap and interest rate swap and U.S. Treasury portfolio. And I also the story that we have to tell to ourselves, or the model we have to use to come up with a better version of the story, is the business model of alternative investment funds and how they exploit so-called arbitrage opportunities. The other part of the balance sheet that I didn't think there is that much of there's not enough. It's not the other part of the balance sheet that I wanted to focus, not because I thought the narratives are inaccurate, but because no one is really talking about it that much, was the credit lines that SVB was extending to not the private equity funds, but the private equity fund managers. And we're going to talk about this. I assume that we're going to talk about the structure of those particular credit line as well. But the point was that when we look at the nitty-gritty of those particular lines of credits, the attraction of those credit lines were is not that much the interest payment aspect of it, but the fact that it can indirectly or again synthetically make SVB to actually be a synthetic or indirect limited partner in case of default by the GP or general partner. So these two narratives or these two observations that I actually had regarding to SVB made me think that what if this is not just a SVB story? What if the SVB is kind of like showing us what is at stake or what is in the mind of commercial banks, and what if commercial banking for medium-sized banks is turning into like an indirect or synthetic alternative investment fund. And that was basically my paper.
So there's a sense, a belief that after the great financial crisis, there was a lot of regulation on the banks that de-risked them and that pushed them into taking a lot less credit risk. That has incentivized credit risk to move from the banking system to the non-banking system, much of which is called the alternative investment world. So that's private credit, that's private equity, other types of non-banks. You're saying that these two systems are connected, and that a lot of banks that have been successful, Silicon Valley Bank, people might forget, was a very successful bank before it collapsed, that banks do well to attach themselves to the non-bank sector and provide leverage to the non-bank financial sector.
That's a great reading of like the main basically result of this paper. And exactly as you are mentioning, what I'm saying is that like it's like a circle that like yes, there was some kind of like credit provision that used to happen in the banking system, regulation and other changes in the market structure, in the banking market structure, kind of like push those activity towards the alternative world, and then they kind of like obviously made it more complex in order to make it more profitable. And now those activities are coming back like to the banking sector, but because of the higher regulation and higher regulatory standard that is faced by the banking sector, there are these kind of like complex credit provision and complex strategies are taking place in the balance sheet of these banking sectors indirectly or synthetically, rather than happening like in a more direct and transparent manner.
So Silicon Valley Bank, over half of their loans were what is called subscription lines, or lending to private funds, I believe mainly venture capital. And basically venture capital and private equity, they go to wealthy investors, university endowments, and they say, okay, give us money. And the endowments say, yes, we're going to give you. But private equity, they don't get the money until they say, okay, we have an investment, now give us the money. But basically a capital call line is the bank lending to that private equity fund to put the investment right away, and then when they get paid back by the actual investors to actually put the fund in between that time, that's when the bank gets paid back. And it sounds like a risky business, and maybe perhaps it is increasing the risk in the overall system, but to a bank, these loans historically have performed extremely well. I know from the Silicon Valley Bank investor report, actually released 2 days before it collapsed, maybe 1 day before it collapsed, that these, in the history of the bank going back to the 1990s, only one of these loans has resulted in a loss. So the reason Silicon Valley Bank failed is not because they're making these risky loans and they defaulted on those loans. It was entirely due to interest rate risk and a bank run. But why are these risks? Why are these loans to the banks? Why are they so safe? I mean, you talked about how they typically make 2% over the risk-free rate. So interest rates now 4.75%. So that'd be making 6.75%. So it's not a super high yield, but these offer a very, very high, a very apparently low risk, right?
Yeah. So thank you so much, Jack, for for talking about subscription line, because that's exactly one of those kind of like important credit lines that exist in the balance sheet of the SVB, and other banks are following that trend. That is, I think it's worth really, really investigating and being highlighted. And thank you so much for highlighting that. As a matter of fact, my idea, but and I know it might be a bit bold, but my idea is that SVB collapsed because it was a very, very bad hedge fund. It was a very bad fixed income hedge fund, as a matter of fact. So, and again, like the timing of like the exit from interest rate swap, just like, they didn't execute the swap spread strategy, which is a fixed income strategy that I believe they were executing at the time. The timing was very poor, and that strategy really kind of like didn't work for them. So in terms of going back to your original question about subscription line, this is exactly another item in the balance sheet of the SVB or business model of SVB that I do think it didn't lead to their default per se, but I think it kind of like is very important and needs to be highlighted for different reasons. So the first reason is that I do think there is an important conflict of interest or economic interest, conflict in the economic interest that is happening in this type of loans. You explained the loans very well, so I'm not going to spend that much time on that. But basically, in short, this is basically a loan or a credit line between the bank and the fund manager itself, the GP itself, and so the interest rate on these loans are not really that high. So this is not something that is creating in a traditional way high yield or high interest payments or high interest income for the banking system. So when you mention that, okay, these are safe, yes, these are safe, but I will walk you through a conflict of interest here that if the default happens in these loans, as a matter of fact, that might be economically better for the bank rather than worse for the bank. So let me tell you why. Because the key here is to understand the nature of collateral that exists in this type of like credit line. And in this case, the nature of collateral is basically the implied asset or capital of the limited partners. Meaning, if the GP failed to actually make the interest payment and the default happens, then the bank can use the power of attorney and does have some say or some share on the internal rate of return that is going to be paid to the limited partners. And in that way, the bank becomes the de facto or synthetic limited partner. And as a result of the default of the fund manager, instead of earning, let's say, 2%, it is going to earn 25% or whatever the internal rate of return of that particular private equity fund would be. I do think, and I do think this is an important consideration. You are so correct. So far, we are talking about like hedge funds that have performed well enough to be able to pay off at least this portion of their debt, but the economic incentive is there that the collateral is extremely more attractive than the interest payment itself for the bank. And also, like, it increases, like, it shows that the banks do have this ambitious to actually become a de facto limited partner. And they want to try anything they can, and it is in their power, and it's allowed by the regulators to have the share of that attractive alternative investment fund. And they do it very in a very covert and very synthetic and indirect way, but they are doing it. So this part of the business model of the SVB and other banks that are actually doing and expanding this type of lending, to me, is not about. It might be considered as dangerous, not because the defaults are very high, but because the way the interests are structured, and that's something that I wanted to highlight.
So if let's say I have a private equity company, Farley Private Equity. People who invest in the management company, let's say I'm publicly traded, FPE, Farley Private Equity, that is a GP. Then I go to Harvard to raise money. I'm an asset management company. Harvard is my limited liability company. You're Silicon Valley Bank. You lend me money. Excuse me. You lend one of my funds money to basically make the investment in between the time that Harvard gives me the money, because Harvard's going to take 20 days. The reality of the fact is, and this is not news to anyone, Harvard's good for it. They're going to pay. So that's why these loans have such a historically low default rate. And you're saying, even if, not Harvard, but, another person doesn't pay, you have a interest in my fund, and you can get a high rate of return, and it's collateralized by those investments. So so it's basically it would be very dumb for me as a private equity GP to not pay you back, is what you're saying. And yeah, these things are safe. Historically, they have been safe, and this is a key financial concept that I'm sure you see all across history, is that safe can be dangerous, and sometimes dangerous can be less dangerous than safe. Like, for example, during right before the Great Financial Crisis, everyone was buying credit default swaps to hedge their risk. But that when people hedge their risk, they're just pushing the risk on someone else. And so the banks may not be taking a lot of risk, but overall they are increasing leverage in the system, even in a small way. I'd also say something that is becoming much more popular now, we can talk about it later, net asset value loans, NAV loans. These are loans to private equity, but basically they're lending the fund money so the fund can become more levered and pay out dividends to their investors. It is not a 20-day transaction or a day in between. Harvard didn't give me money for 2 weeks, so give me a loan that's very safe. These are much riskier. But the overall point is just that banks are getting very involved in the non-bank financial sector, and a lot of very smart people and very smart regulators have had the view that banks have been de-risked because all the risk has been moved out of the system, when actually it's just been kind of recycled. And private equity companies, they are taking credit risks, and the banks aren't taking those credit risks anymore, but they're lending to the people who are taking those credit risks.
I couldn't agree more. And again, like always, the way you conceptualize all these ideas and put them in one frame is fantastic. And thank you, Jack. And I also wanted to say something about the GPs. You are so right. The GPs have all the incentive in the world to pay off but also in terms of again the incentive. But one of the reasons that GPs are actually kind of you might use this line of credit is that they want to postpone the capital call, and so you need additional capital. But instead of doing something which is so unfavorable for you and so unpleasant for you as a GP, that actually call investors or LPs, limited partners, to actually kind of inject more capital, you're gonna call your bank, and the banker is gonna lend to you, and the banker is gonna lend to you because you are using the money that will be posted by the LP as an implied collateral here. And in doing so, as GP, you are going to superficially increase your your rate of return at the time, which is gonna be very important for your fees. And so this kind of the structure of the interests here can be very delicate and very risky in this loan, and that's why I think we should have a much better examination of what's exactly going on. And I know it seems like you had a question or a follow-up point, so I will pause here.
And excuse me. So that is such a key point. I'm so glad you brought that up. Is that the shorter the duration that the Harvard, the LP, has given the money, the
Exactly.
higher the rate of return. Because let's say the rate of the return of the deal is 300%. If it's a 6-year deal, that's 50% IRR. But if it's a 5-year deal in 10 months, the IRR can be slightly boosted. So private equity funds, many of them have returned extremely well to investors, but they, these internal rate of returns, they are boosted by the fact that the numerator is how much money you made from the deal. The denominator is how much time you have the deal. So if you can shrink the denominator by just a little bit, by a month,
Exactly.
then you increase the IRR. And then that can help you fundraise, because then you go to Harvard the next time and you say, hey, we have a 30% IRR.
I totally
Internal rate of
agree.
return.
And you explained it so well already, and I just want to kind of like emphasize what you said is the importance of what you say, what you just said, that it's exactly, you're, in a way you're really superficially just increasing the attractiveness and the financial performance of your firm. And this is, I think this is something that worth investigation, and the banks are a silent partner in this game. And it is important to, I think, appreciate that or understand that.
Yes, and by the way, it's not necessarily bad for the banks. Silicon Valley Bank, many of the units, the business units, have been bought by a bank. The ticker's FCNCA. They're doing quite well. Like the reason that the business is Silicon Valley Bank failed is because of a bank run, and they had really horrible interest rate risk. And you said they were a hedge fund. If that's true, they were a horrible hedge fund, and they were
Hedge
taking
fund.
tremendous amounts of interest rate risk that you really would not take unless you are a bank. And that is the thing. Banks are be given a privilege
Exactly.
because they can create money and create deposits. And some of them manage it really poorly. A lot of banks managed that really poorly in 2008. And then regulations, handcuffs were put on them for credit risk. But in interest rate risk, they've been incentivized to take on lots and lots of interest rate risk. And then in 2022, interest rates rose and they lost a lot of money.
Exactly. And also I wanted to say something about like this, the relationship between this line of credits between such a subscription line, which is between banks and the fund managers themselves, and the amount of venture capital deposit that was coming to the SVB. And so because there's this very nice paper, I'm happy to share the paper with you and your audience, by BlackRock, and study the same phenomenon. And as a matter of fact, one of the attraction of this line of credits for the banks is that because there is this kind of like gentleman agreement between you and the fund manager, the expectation is that the fund manager is going to use your bank, to deposit the funds of that particular venture. And so in a way, they are also kind of like buying deposits from this fund manager. So I think this is creating even a closer correlation between the credit worthiness of the fund manager in terms of like whether fund and that particular hedge fund or the fund manager is good enough to be actually a good counterparty in terms of the credit lines that the bank have expanded to them. And at the same time, the bank is running its operation based on the deposits that these very same counterparties are depositing or posting in your banking system, and which is your main source of funding, which was the case for the case of SVB, or in the case of SVB. So it is just like, it's like this complex web of like you are lending to someone, and the implied expectation is that then use my bank to deposit this as your main bank, and this is how you're attracting deposits. I think this is also something that we need to investigate more.
Yeah, and there's a slide from Silicon Valley Bank investor deck saying, so 50% of their loans were these capital call loans. A teenage percent, like 15% of their loans were like mortgages to ultra rich people who were the VCs and the people basically giving them sweetheart deals. And obviously, if you're a very wealthy person, you are creditworthy, and that might merit a low rate of a mortgage. But I mean, Mark Zuckerberg famously got a 1.05% mortgage rate from Silicon Valley Bank, and that is a business agreement called tying, where I give you a favorable treatment here, you keep your bank deposit there. That I think, I'm not a lawyer, but like in some way it's frowned upon by the law, maybe like technically illegal, but the reality is it happens in banking very frequently, and that is Silicon Valley Bank was the epicenter of that.
I totally agree.
Yeah. Okay, so let's see. What was I going to say? So Elham, in your courses, you've been talking about accounting for private equity firms. That is a fascinating subject to me because I'm become familiar with the accounting for banks, so I get used to like speaking one language, but then the accounting for private equity firms, GPs, is totally different. And you've been talking about in a previous conversation we had about how Apollo, a very large private credit and private equity firm as well, they are basically giving certain guarantees to their investors.
Yes, and I'm so glad we are going to also talk about the teaching, because I love teaching, and I've been inspired so much by the courses that I'm teaching and also my wonderful students. And one of the recent examples of that is this course that I started to teach at Barnard College, Columbia, which is accounting and finance for economics. So usually this type of courses is about using or teaching very useful the tools of the tools of accounting to understand the business model of manufacturers. For example, like Chipotle is an example that is in the textbook. That's being kind of like practiced by so many students, by so many professors I know. But what I started to do is that I do know accounting, but I'm not an accountant. But I love finance and I love alternative investment funds. So the way I'm gonna teach my course is that this course is going to be about using balance sheet tools to understand off-balance sheet operations, and for that purpose, nothing was better than understanding the business model of alternative investment funds using very standard accounting tools. So one of the biggest examples in my course is the use of Apollo and the balance sheet, and examining the balance sheet of Apollo to kind of like to try to match what Apollo is doing with what we are hearing in financial world, in the financial news by people like yourself about what they are actually trying to kind of like achieve or in the world of finance. For example, we know that Apollo is a private credit fund. We know that Apollo is a private equity fund, but we don't really know that much who are maybe the de facto counterparties or the de facto partners in a specific type of private investment that they are doing. And but when we look at the balance sheet of Apollo, there is this item in the balance sheet which was funds withheld at interest. And I don't want to kind of like claim that the answer to so many questions that we might have about, let's say, how many pension funds, how many insurance companies are actually especially pension funds, these important institutional investors, are the limited partners for in some of the risky and complex investments that Apollo is doing in the private credit or private equity world. So I'm not saying that this particular item is going to fully answer the question, but this item in the balance sheet is going to give us some clue. So how come? When we examine the definition of funds withheld at interest, so basically, simply put, this is something that SEC is requiring. This is based on the regulatory requirement that has been imposed by SEC, and in order to protect certain type of investors. So the idea is that once an alternative investment funds, such as Apollo, is investing certain type of institutional investors' money, such as pension funds, in complex financial investments, then some portion of that return should be already insured. So so if you are a pension fund and if you want to have more exposure to the higher yield, and therefore you decide to actually invest some part of the pensioners' money at Apollo, SEC is requiring Apollos of the world to actually kind of like insure part of the return, so that if the investment goes bad or goes wrong, some part of the yield that was promised to these pension funds are actually being returned to this or being paid to these pension funds. So there are different ways of doing so. And but when my students and I were investigating, we saw that it seems like one of the ways that Apollo is trying to kind of like comply with this requirement of the SEC is by insuring some portion of some portion of these institutional investors' investment through a fund which is called funds withheld and interest. So it's a kind of like insurance and protection for that Apollo is offering, just in case some of those very complex investments doesn't pay off. And the idea is that this insurance is going to ultimately protect the pension funds of the world who are investing in these risky investments. So I want to pause here and stop here, because understanding the business model of alternative investment investment funds through their public balance sheet and financial statement is not very easy. At the same time, there are so many clues out there for us, and that can help us understand what is happening much better than what we think we can.
And so Apollo, they have a private equity arm, but the bulk of their assets are in credit. Some of that credit is in non-investment grade, the very risky deals. But it's my understanding Apollo also has private investment grade, which is basically less risky. You're supposed to be risky. And it's also my understanding, Apollo, as we record on late 2024, they have done quite well for their investors, both in private equity, but in private credit, in the non-publicly traded credit. Tell us about these guarantees, because when a deal is risky, it's high yield. Okay, if it works out, you're going to make 16%, but there's a chance it doesn't work out. So if it doesn't work out, you accept that. But an investment grade deal, there's supposed to be some protections, right? I mean, if you're lending money to Johnson and Johnson, that they're good for it. They have a lot of money. If you're lending money to Apple, they're good for it. But how do you have an investment grade deal if you're lending in a private company to a deal, but maybe a company people haven't heard of? What are those investor protections, and who's on the hook? Is Apollo on the hook of Yeah.
That's actually an excellent question. So so the structure of these funds are, I'm still investigating and I'm trying to understand every nitty-gritty of it. But my understanding so far is the following, that there will be a third party involved here. And basically that third party is going to require the Apollo to actually kind of like put a certain portion of the money or investment fund or those funds that are supposed to be invested in that particular third party. So the Apollo is going to post like a certain amount of fund into that third party. And if Apollo actually even kind of like add more money than it is required, then that additional money or extra fund that is being held with the third party is going to actually be paying interest payments. So and then this fund is going to be is going to be kept or being held by the third party. And then once the original investments that we are all talking about kind of like paid off, then you can actually kind of like liquidate these funds. And otherwise, if something happened and the investment was not able to pay as much interest or return as you were kind of like hoping for, then it seems like this insurance fund can cover some of those losses. And I will.
Sorry, Elham, the insurance fund. Please. Where is that protection? If the deal goes wrong, there's money in the insurance fund that makes the investors whole or more whole. Where is that money coming from? Because coming from Apollo, it's coming from other
It's gonna
parties.
come. It's gonna come from Apollo.
Okay, interesting.
So it's, in a sense, SEC is kind of like requiring. It's not a legal requirement. Again, this is one of those blurry points, because on the one hand, Apollo and other private, especially large alternative investment funds, are complying with that, but they are not also very high. They are not also legally required. So I don't want to enter there, but the moral of the story is that SEC wants to actually protect these institutional investors, especially pension funds, who want to actually invest in the private alternative investment fund world, by requiring Apollo to actually insure part of the return. So this money is going to be paid by Apollo.
Okay, that's interesting. I didn't know that, and that is really interesting. I feel like so Apollo did buy an insurance company called Athene, so they have a lot of money from the premiums that they charge those people, and so that they invest a lot of those money, but they're also raising money from external funds, and that is a theme. We live in a world of aging demographics, and old people have savings, and there is a glut of savings. So there's just a tremendous amount of money that if you're 7 years old, you can invest a little bit in the stock market, but you need some protection. You need some investment grade bonds. And Apollo is saying we can outperform the publicly traded investment grade market, and it's my understanding that so far they have. And so a tremendous amount of money from insurance companies and the institutional investment world is flooding into these products. And it's interesting. Elham, we actually met at an event. Co-sponsored the Jain Family Institute, where you're a research fellow, and then also the Yale Institute of Financial Stability. Shout out to Stephen Kelly. And there was talk there of a private credit ETF, and it seems like since we met there, that ETF has now been filed with the SEC. Tell us about that. I really struggle with that, because private credit, it's private. An ETF is publicly traded. There are and I no commercial relationship with this fund, but there's a ETF. It's BKLN, the Invesco Senior Loan ETF. So senior loan means they're lending to companies that very high level in the capital structure, senior, and so it's a floating rate loan. Basically, the banks used to own BKLN, and now so now we own BKLN, the investment public. So I understand there's a asset liability mismatch. You can buy and sell BKLN every single day, but obviously these loans trade less frequently. However, they trade a little bit. But private credit, the whole thing is that you own it for 2 years. How does this work?
No, that's a very, very good question. If I say that I do, I know how this works. That's a big lie. But just but something that I've learned so far about this is that, so basically, there are there's going to be a few major players like Apollo, KKR, State Street, and also, Citi actually, and so. Like every ETF structure, we do have an AP, authorized participant, we do have an issuer, and we are going to have a market maker, and also obviously the normal clients. So in this case, the role of Apollo is going to be very, very important and interesting, because it seems like what Apollo is going to do is that, okay, the idea is that they are going to make secondary market in private credit, and the instrument that they have picked in order to create a secondary market in private credit is an ETF. So they want to actually create private credit ETF, and through that create a secondary market. But in order to make sure there's a liquidity in the secondary market, they need to actually add market making function. Then the question exactly is, there are so many questions, but one of the important questions here is that, so if you are making market, if you're a market maker, you wanna be on the other side of every trade. So you want to be a buyer, but you also want to be a seller. But in private credit, the deals, there might be a seller, but it will be very unlikely that you will find a buyer. So in this case, the market maker should have the capacity to absorb so many inventories. So the question of how a private credit deal that is so private can be even considered as a tradable inventory? That's a very big question. But I'm even looking at, like, let's assume that there's a financial engineering that works, but then in this case, we are really going to face a situation that, at least for the first few years, the market maker is basically going to be a one-sided trader, that probably it is the one who is just buying these private credit deals, and because selling it would be more difficult. So in order to be such a market maker, you should have a very big balance sheet. And I think Apollo wants to actually adopt this role, that I'm gonna use my balance sheet to absorb the private credit deals, but over time I'm gonna actually create secondary market and make sure that these deals are also tradable, can be sold to someone else, and then I become more like a normal security dealer. So in this case, I think the role of KKR would be like, KKR is going to issue these private credit deals. And so the issuer is going to be KKR. Let's say the closest player to authorized participant / market maker would be Apollo. And so this, I think, in terms of like the players, this is how the market is structuring right now. Then the $1 million question exactly is the redemption. That, for example, like if the underlying assets in these ETFs are highly illiquid private credit deals, how can you redeem the ETF and in order to have the underlying assets? So something that I think we can be for sure is that this is not going to be an in-kind redemption process. It's going to be a cash-based redemption process, which means that you're going to actually you can redeem your ETF if you can, assuming that the market actually works, but only you can, but you get cash for it. And then that leads you to the next question of, like, again, like, which is going to be the first question, is that how would you price these deals? And in a normal, this is where I think this point is the point that actually makes Apollo extremely important in this whole process, because usually when it comes to valuation, a market maker is one of the biggest, like, price setters in any type of, like, trading system. And in this case, because our market maker is Apollo probably is going to be the one who actually set the prices for these private credit deals. But because there is no actual secondary market yet, it is going to be basically Apollo's internal model, and whatever they decide, what the value of each private credit deal is going to be. And obviously those internal models by Apollo wants to actually set the prices and find the prices that ultimately create a two-sided market, meaning the price is good enough so that it attracts both buyers and the sellers, so that the price discovery process is going to mostly happen through the balance sheet of, or through the model or business model of the Apollo. So again, this just shows how internal or integral or important the role of Apollo is going to be in this market. But there are so many unknowns here, of course, and all of you know that I'm basically missing out so many details, mostly because I don't know those details. But I think one thing that is going to be very, very important is that it is as if we are, in the name of creating secondary market, we are creating this derivative of private credit market, where the sole price setter is only one entity, which is Apollo. Apollo is doing, because so far it shows that it is more committed than the rest of us in creating a secondary market for private credit deal. But the power that Apollo is going to get over the private investment world is going to be extraordinary. And So we can discuss the merits of this, and we can discuss the risks of this. But it is just like something I think very interesting is happening in this world. Not because it is new; it is not new, because like I think some of the financial engineering problems have already been solved when we created fixed income ETF, because fixed income is also not a very liquid market. Yes, U.S. Treasury is very liquid, but as we know, not all fixed income is U.S. Treasury. We do have high yield, which is really not very liquid, but we do have high yield ETF. So how did we resolve that issue? So we do have so this is just a natural development of what is happening in the credit system in general. But until we get to the point that we do have a very robust secondary market, one player is going to become the king of private credit, and that's going to be Apollo, because I'm assuming that the king is going to set the prices for the rest of us in this market.
So KKR is a private equity, private credit firm. Apollo, private equity, private credit firm. State Street is a bank, one of the oldest banks, but they're an ETF company. So KKR is doing the deals. Apollo is the market maker or authorized participant, AP, and then State Street is the ETF wrapper. Do I get that right?
Yes, I think, yeah.
Okay. And so that's interesting. So an authorized participant is basically, State Street, they have an ETF XLK technology. I buy a bunch of XLK. You are
Yeah.
the authorized participant who I guess technically sells me the XLK, and then you buy all the stocks that are in XLK. You deliver it to State Street. They give you the XLK. So now you were short XLK. Now you're long XLK. So you're neutral. And then I have the exposure, and State Street has the asset. So that is what Apollo will be. And also it's important. So you're right. Like a high yield ETF is liquid, and they are much more liquid than the high yield bonds that are in the ETF. However, okay, Carnival Cruises is an HYG, the high yield ETF. It might take a day or two to sell that Carnival Cruise bond. It may take a week, but you could definitely sell it. However, private credit, some of these deals are okay. Apollo lent money to Intel. I'm sure there's a market for Intel debt. But what if there's a private equity consortium? They basically bought a bunch of laundromats and then rolled them all together, and then they borrowed money from a private credit fund to pay themselves a dividend. Who wants that? That's not liquid.
Exactly, that's why then it becomes to the pricing. And also I want to go back to what you said, the way that you conceptualize how the market is shaping, which is so correct. Like the issuer is going to be a State Street, the AP slash market maker is going to be Apollo, and the company or the fund that is going to actually create this private credit, and then kind of like is going to be KKR. And so this is exactly the structure that you just mentioned. And going back to the question that you just raised, this exactly just shows how critical the role of the Apollo is going to be as a price setter, as a kind of like the de facto price setter here, because when it comes to the high yield bond, at the end of the day, you are actually going to sell it, because you know that the market is going to come up with a price that is going to clear the market clearing price. So, or a price that actually would lead to the execution of a trade. If it doesn't clear the market, I think I have to take a step back. I want to remove what I just said about like market clearing price, but a price that's going to kind of like lead to the execution of the trade. But now we are actually the market that is going to come up with a price that leads to the trade execution is only going to be Apollo. So it's Apollo and the prices that is gonna test in the market, is gonna make or break the secondary market in ETF.
And you say Apollo is going to be the king. I think Apollo is definitely the leader right now in private credit. But what about the other, strong players, in private credit? Ares, Blue Owl, Blackstone has a very large private credit firm. Why are they not going to do this? Why is it going to be Apollo as the king, as you say?
And I think more than how big Apollo is, which it is true. It is the biggest and one of the oldest private funds. It is about like the role that is adopting in the system, and like I do so any player who is more closer to the role of a market maker is ultimately going to acquire more market power to set the prices. And it is in that regard that I do think Apollo is setting itself to become a king, not because it is necessarily the biggest, not because it is the most sophisticated. We do have so many, as you mentioned, really like competent and big private equity and private credit fund in this case, because we are focusing on private credit funds. But the role that Apollo is taking on, and it's taking so much risk for it, is basically becoming the first market maker in the secondary market for private credit. And again, as I just said a few minutes ago, I do really think that this means that Apollo is preparing itself for absorbing so many trade imbalances for the first few years. And in doing so, it's going to be exposed to so many risks. So it is taking on this risk because it just wants to have that role in the private credit market of becoming the market maker. And if that role realizes, then no one has the absolute market power to set the price, but Apollo is going to have the highest or the highest market power compared to the other funds in terms of how much each deal needs to be priced.
Yeah, when I first heard the term private credit ETF, I had a visceral reaction like that's not going to work. And I think I have to, as when you have that reaction, somebody say, at what point is my instinct right? At what point is there a lot of stuff that I don't know? There definitely is a tremendous amount of stuff that I don't know. Probably our viewers don't know. I mean, you say you've been studying this stuff and you have a lot of questions, a lot of stuff that you don't know. So anytime you have a new thing, there you got to do. I will say, Mark Rowan, the CEO of Apollo, I've listened to him on many podcasts. An incredibly impressive guy. So yeah, he's and he just has a way of explaining things that makes it make sense. And hearing you talk about it now it makes a little bit more sense. And I will say I know of many ETFs that have insanely illiquid underlying assets, but they work as well. So this thing works. Okay, but you say Apollo is going to have a lot of trading balances. So someone wants to sell the debt of the laundromat roll up, they have to buy it, and then they're gonna hold on to that until they sell that. In the same way, before the great financial crisis, Goldman had a lot of high yield bonds, and they absorbed that, and then they sold that. They were a dealer. Obviously, they still are a dealer, but that capacity has been reduced after the great financial crisis. So how does a non-bank act as a dealer? Because the whole thing about a bank is that you can basically create money. I think Goldman, was not a commercial bank until after, during the great financial crisis. So I guess the way that they did it was if they needed money, they just issued a bond, and that's how they fund themselves.
That's an excellent question. Like, as a matter of fact, most of the largest dealers are non-banks. It has a security, Virtu Financial, like in Europe, Fellow Traders. These are
Okay,
all non-bank financial. These are all non-banks like dealers and
good
market
point.
makers.
Good point.
And in terms of like so how do dealers work, and what's the difference between non-bank dealers and bank dealers? So when it comes to bank dealers, one of the so banks do have this this comparative advantage in being a market maker in like wholesale funding market. For example, when we look at the repo market, most of the dealers are large banks. JP Morgan is one of the biggest like market makers in the repo market. And the reason, and this is very closely related to what you said, the reason is that so you are as a bank, as a JP Morgan, as a repo dealer, you are basically like making market in a term funding such as 3-month repo, but you are able to finance your inventories very cheaply. In, let's say, in the past it was through the like federal funds market, but now it's like a standing repo facility or other facilities that is going to provide you very, very cheap funding. The point is that if you are a bank, you do have a comparative advantage in the wholesale money market just because you might have a better relationship with Federal Reserve and very, very, very cheap source of funding. But in the longer term assets, in the capital market, most of the dealers are actually non-banks. And how do dealers fund themselves? And that's where it has become things become even more interesting and more interconnected, because the balance sheet of non-bank long-term capital dealers or capital market dealers are connected to the balance sheet of short-term money market dealer, which are mostly banks, because the funding needs of these long-term security dealers are usually coming through the repo market, or being covered through the repo market. And in the repo market, JP Morgan, a bank, is the biggest market maker. So as a market maker in repo market, one of your biggest clients are the security dealers who are making market in the long-term assets or long-term financial instruments. And when they do, when they do have a long position and inventory in that particular asset, and they need to fund that inventory, they usually go to the repo market in order to finance those long positions. So, so if you are a non-bank, as long as you do have a very good relationship with the banking system and the repo market, you can be an excellent long-term security dealer. And that's exactly what is happening in the capital market. And in this case, when it comes to private credit, the nature of funding is going to be very interesting, because again, the elephant in the room is that the valuation, the price discovery process. And so let's assume for now that your model as a market maker, or you do have very sophisticated model, or your risk management models are sophisticated enough to be able to have a very good estimation of your exposures to these private credit deals that you have absorbed in your balance sheet. But then again, the question of valuation is going to be very important, because that is going to determine your funding needs. But who is going to fund you? Excellent point, Jack, because probably banking system. And this is telling you that in this secondary market for private credit, through the creation of like private credit ETF, we are opening a very nice and important door between the bank funding and private credit world. And in this case, the market maker in private credit is going to finance its inventory positions in private credit market, but through repo market. And the biggest players in the repo market, the biggest market makers in the repo market, is basically the bank. So therefore, through the banks. And I think this is something that we should explore. But I want to pause here, because conceptualizing the economics of private credit dealer is a very is a very careful, and is a very kind of like complex task. So I need to be more careful and saying anything, but I just try to use some of the knowledge that we have when it comes to more regular security dealers, in order to conceptualize or predict what is going to be the main funding need of a private credit ETF market maker, and how those funding needs are going to be funded or are going to be met.
So a repo is a repurchase agreement, often overnight. So in the risk-free or ultra low risk world of financing a 1-year treasury note, you can if I'm borrowing money, let's see, I quote unquote sell my security to you, my one note treasury to you. You give me, let's say, $98, $99, and then I buy it back tomorrow. So it's basically a one day loan, but it's I'm selling it, I'm buying it back. That's what repo is. And because it's a 1-year treasury note for a 1-day risk, that's very low. That's why you can give me $99, probably more. But for Citadel borrowing in the repo market, they are trustworthy, creditworthy, but they are dealing in stocks. Stocks are a lot riskier, so they have a higher haircut. This nascent world of market making in private credit loans. I mean, what is the haircut on that? You know, is it 60 cents? Is it 80 cents? Is it 99 cents? And then also, yeah, I mean, basically the private credit world is becoming very, very levered, as it is a market maker in loans that, you know, are very illiquid, and they are borrowing money. So they are borrowing short. The whole thing about private credit is we're not borrowing short, which they haven't. They you know, get 20-year money, 10-year, 5-year money from a pension fund or an insurance fund, and they invest in a 5-year loan, and the deal that they are matched. They don't have that asset liability match that a bank has, that Silicon Valley Bank has, of overnight deposits, and they buy, you know, all these mortgage-backed securities that have no credit risk, but they are very long-term securities. Now Apollo, now all the private credit firms are in the future, not now, but in the future, they are going to have a lot of short-term funding, is what you're saying.
Exactly, and as you mentioned, like there's so many interesting questions here, like exactly what is going to be the haircut, and you know, like and the interesting thing here is that, again, like, you know, because like let's assume before the market becomes really like competitive in terms of like the market for being a dealer in private credit ETF becomes very competitive, and then until like Apollo is the dominant player in this world, this means that, like, because the haircut really depends on like how risky the asset is, and so I was thinking that because Apollo is going to have such a big market power in setting the price of these assets, indirectly it also kind of like is going to have important say in the haircut of the same asset that could be used potentially as a collateral to raise funding for that asset. And again, this is one of those things that I need to sit more and learn more about, like the valuation of private credit in the secondary market. But I do think like this just shows that everything we are talking about is pointing us to this direction of the role of Apollo as the biggest and fairest market maker in private credit is going to be significant, and it's going to be felt in every segment of a financial system, including in the short-term funding market and the repo market. And so I just thought this can be a nice way of kind of like wrapping this part of our argument about this private credit ETF, that the private credit ETF or the secondary market in the ETF is gonna create so much exposure between this market and other segments of financial system, including the repo market.
Yeah, it's interesting. And, you know, the way finance works is most of the time there's more buyers than sellers, and you know, credit conditions ease. But then, you know, once every 7-10 years, there's just a total freeze up, and there's no buyers, and everyone wants to sell. And regulators have said the best repository for this risk is outside of the banking system because they don't have this run risk. But now you're saying that there could be a run risk if this private credit ETF goes through. And, you know, it depends. If the private credit ETF is only, you know, $15 billion in AUM, or only $5 billion, it's not that big of a deal. But if it becomes huge, then that is a bigger deal. And also, I say, so everything we're talking about, you know, maybe the way we've been talking about it is as if it's already exists, but, you know, it's been filed with the SEC, and this is something that might happen. Elham, now I want to talk about something that has been happening over the past 2 years. I mean, longer, but especially is what we started, the banks lending to alternative asset firms. And so we talked about the capital call loan of Silicon Valley Bank lending to private equity and venture capital subscription lines, which are not nearly as risky as what I want to talk about, which is, you know, over the summer, Ares raised a huge private credit fund, and it was levered. It had I'm going to get the numbers wrong, but, you know, a certain amount in equity. I'll make the numbers up. They're reasonably, you know, 15 billion, 20 billion in equity, and then 15 billion in loans in borrowed. So it's a $35 billion total fund, but 20 billion. So that $15 billion, again, my numbers are not precise. Is that coming from the banks, and how does that shape your view of the bank's risk to the non-banking sector? Like, let's say JP Morgan is loaning money to Ares, or is it to the Ares funds? And What is the risk to JP Morgan, and how should regulators think about that?
That's an excellent question. So when we think about the footprint of banks in the alternative investment fund world, there is a direct footprint and an indirect footprint. The direct footprint is that, okay, we talked about subscription line, but the subscription line, I would actually put it as kind of like indirect footprint, because technically the subscription line is between you and an individual fund manager. But when it comes to the direct line, I'm really talking about some of the loans that are directly between JP Morgan and the fund, or some of the line of credits that's directly exactly between JP Morgan or the banking system and the alternative investment funds. And these are like business loans. And some of these business loans, they earn like floating interest rates. So it's very kind of like a plain vanilla business loan for the bank. And then the other footprint, and then the other aspect of the direct footprint of private alternative investment funds in the banking system is exactly like the deposits that some of the commercial banks, medium-sized commercial banks, as was the case of SVB, they are actually mostly serving this type of clients. So the deposit on the liability side of the commercial bank, the deposit from VCs and alternative investment funds, and on the asset side of the commercial banks, the business loans to these funds are the direct footprint of the banking system. So in the alternative investment world. So when it comes to the risks here, I would say that the risks are there. They are risky. Actually, SVB kind of like collapsed partially because there was a run after the run actually materialized on SVB deposits. So they are very risky, but they are traditional banking risks. For me, where I'm really I'm comfortable and where I want to explore more is the risks that are associated with the indirect footprint or the indirect involvement of commercial banks in the alternative investment world, including what we were saying about the subscription line, how the incentives are structured there, and basically it can create so much leverage in the alternative investment fund world that could backfire when it comes to the banking system. It could backfire, and some of those instabilities that might generate in the alternative investment fund world can spill over into the banking system. So the one indirect way of involving in the alternative investment fund by banks is through the subscription line, and I do think it can be the point for concern from financial stability perspective. And the other aspect is when banks want to actually replicate, again, the investment strategies of the alternative investment funds, just because they want to be able to get some share of those higher yields that are being generated in that world. I know this may not be in the form of banks are having a relationship, a specific type of relationship, financial relationship with alternative investment funds, but they are learning from alternative investment fund strategies. They are trying to replicate it but in the context of the banking system that is highly regulated, and because they are banks, they are not alternative investment funds. They do not have the same sophistication in terms of risk management. They will become a very bad fund manager. And to me, this desire to restructure your business, and instead of being a bank, both directly and indirectly, both in terms of action and also in a spirit, you want to actually kind of do as many banking service as you need to in order to maintain your banking status, but everything else, all the other activities, you want to restructure them to somehow replicate the yields and investment strategies of the alternative investment funds. So to me, this is something that worth investigation, and we need to kind of the identity of the banking system and the DNA of the banking, especially commercial banking and medium-sized banking, is changing, and that DNA shift is shifting towards the one that is that mostly represents alternative investment fund behavior, but banks do not have the tools to actually become a successful fund. And this mismatch between the comparative advantage of the commercial banks and the tools they are very good at and what they want to be, I think is a source of financial stability concern. And I will pause here in case we do have more specific points, but this is something that I wanted to highlight in this topic.
So you said how there's banks have direct and indirect exposure to the non-bank sector. Let's forget about liabilities. You're just talking about assets. So what is direct and what is indirect? You said earlier that some banks have they'll loan to a thing that's vanilla. But to me, I mean, were you referring to the example of JP Morgan lending to an Ares fund? And by the way, that to me doesn't seem very vanilla. And also, that is way less vanilla than even the Silicon Valley Bank loans, because the Silicon Valley Bank loans were a loan to the fund that they're going to be paid back when Harvard, the LPs, give them the money. The leverage doesn't stay, it leaves the system as soon as the LPs pay. The leverage stays in the system. The fund is a levered fund. That's how it works. And in the private equity fund that Harvard is investing in, that could be a levered fund, but the subscription line isn't part of that leverage. Here, the JP Morgan, they're adding to the leverage. So is that direct or indirect, and is it vanilla, or did I misunderstand that?
No, that's actually a very good point. So the way I define vanilla banking versus the synthetic or non-bank way of doing the banking system, doing the banking activity, is the following: that by vanilla, what I meant is I don't mean like non-risky, but I mean something that banks do. The type, it's through the type of loans that are banking loans, that are bank loans. And I do think that even in the example that you mentioned, at the end of the day, this is an example of a business loan. And banks do have all the talents. I mean, I hope so, right? Like, we are talking about JP Morgan. Like, banks are extremely skillful, and they have all the right skills and tools to actually kind of manage those type of business loans. And the structures, the economics, the incentives, all are very in line with, again, when I say traditional, I don't mean simple. I don't mean non-risky or safe, but they are very in line with the traditional business loan that banks extend.
And sorry, and JP Morgan lending to an Ares fund, that you think that's vanilla?
I should know more about that particular, but through which type of loan that funding has happened, I don't know that. But if it is in terms of if it is in form of a business loan, I would say that it is vanilla in a sense that they are using an instrument in order to extend this particular loan or credit. They're using an instrument that is a traditional banking instrument.
Okay. I mean, basically, you're lending to a fund and you're increasing the leverage of that fund. I mean, up until recently, private credit said we're not levered. I mean, now I think a lot of private credit funds are levered, but to me, that seems riskier than what we started our conversation, which is a subscription line to, all these private equity firms where, Silicon Valley Bank, they had one loss in the history of the business, one loss.
Jack, I totally agree with you that a bank loan, a traditional bank loan, can be considerably riskier than a subscription line. So that's why vanilla versus non-vanilla, to me, it's not about what is risky, what is not, but what is in line with the DNA of banking, and what is the banks want to become a non-bank, what is converting the banks to become totally something else, potentially.
Okay.
So it is in that regard that I do think, let's say, extending a business loan to a fund, even though it's considerably riskier than a subscription line, but it is a vanilla banking, because we are talking about a very risky business bank, but business loan, but it is a business loan, and but a loan that, and so many of loans like that have gone really bad so fast, so much, and it has created so much losses for the banking system. But it is a banking type of loss, is a banking type of risk. But when it comes to subscription line, for me, my measure of whether it is risky or not, or whether it's vanilla or not, is not whether the default risk is higher or not, but the way the subscription line is structured and what banks want to achieve out of this particular contract is putting us in a territory or the era of banking that there are so many unknowns. And this future, is not a future based on traditional banking instruments and traditional banking doctrines. And it is in that regard that I would say that this indirect footprint of banking in the alternative investment fund, where you are actually doing something which is seemingly very safe, but inherently it is making you into another type of financial institution, from being a bank to become a synthetic limited partner. I think it is in that regard that there are so many risks associated with this shape-shifting activity that does not exist in the even in a very risky business loan. And so it is in that regard that I'm classifying some of these activities as vanilla and some of them as non-vanilla.
And so Citi, I know, had to deal with Apollo. Is that vanilla or is that not vanilla?
So would you elaborate on that?
I just know Citi they announced some partnership. I don't really know the details.
Citi and Apollo. That's a very good point. As a matter of fact, I am in Market Microstructure project. I reached out to the head of that deal from the Citibank's side, and I'm really hoping to talk to him. And so far, he's been so kind and he's been responsive. But the reason is that I really don't know what that relationship and partnership is about. And I want to get more detailed about it. But once we get the detail, we can either reach the conclusion that, oh, this is a very risky, complex bank loan, or no, Citi is actually kind of like, again, adopting a new hat. And the operation itself is not very risky, but the role that it enables Citi to adopt in the alternative investment fund can be very tricky. And it is in that regard that contract or that partnership would become non-vanilla. And but this is something that I'm really hoping to talk to the Citi folks and get some insight.
Yeah, I guess any like bank loan to a fund, a alternative investment fund, to me it seems like that's kind of new. I mean, alternative investments, really have boomed for the past 20 years. There's not a lot of history there. I mean, presumably, if a bank lends to a alternative investment fund, a credit fund, and the deal goes bad, they do become an LP, or they have access to some type of collateral, right?
Yes, but the thing is, at first, if it's a physical collateral, for me, like, that doesn't make a bank an LP. That doesn't make a bank an old school like bank. That, like my mortgage. If someone doesn't pay the mortgage, like the house is like is banks. It's not yours anymore. So it really depends on like the nature of the collateral. So really, maybe one thing that is very important here is that, first of all, whether the bank is lending to the fund or to a fund manager. For example, this can be important, or it cannot be important. For the case of subscription line, I do think it is very, very important. But also the other important aspect of this credit activities is that what is the nature of the collateral? If the collateral means the seizure of like financial assets or physical assets, to me, this is, at least from the collateral perspective, this loan is a typical bank loan. But if like the collateral is something as indirect as like the implied commitments of the LPs, that's important, because this means that what really bank was after was to have some share of the internal rate of return that usually was just only being harvested by the limited partner, but now banks want to become a synthetic or de facto limited partner. But when it comes to the seizure of physical assets, then this is sending me the signal that banks just want to be a bank in this particular deal. Of course, it's a very risky, loan, or therefore I'm assuming that like the interest rates are already adjusted and everything. And that's exactly the point, Jack, that if it is a, let's say, vanilla bank loan, even if you are actually lending to a very, very exotic fund or exotic firm, such as an alternative investment fund or private credit fund, then you will see that, for example, is going to be that risk is being reflected into the interest rates. So into the nature of the collateral that the bank is going to seize if you actually are not able to pay off your debt and default. But when it comes to, let's say, non-plain vanilla / identity changing type of financial instruments or credit instruments that the banks are extending to the alternative investment funds, when we are talking about those that have very low interest rate. So you can see that this bank is not extending this loan because the interest rate is very attractive. But then when you look at the collateral, the bank is not interested in seizing the office spaces or the buildings that this particular fund has, but it wants to have some share of its future return. Then you will see that, okay, this is not a traditional bank. This is not a banker who is thinking and acting like a banker, but rather this is a banker who is actually daydreaming about being one of those limited partners. And it is in that regard that I would call these type of loans non-vanilla, because these type of credit instruments or loans in the asset side of the bank is making banks synthetic alternative investment funds.
And so what your definition of non-vanilla would be something that has an LP-like payoff or an equity-like or non-convex payoff of, if it works, it does great, but your downside is not protected. A vanilla is your downside is protected, but your upside is capped.
I think that's a way of I think that's a good way of conceptualizing it. And but yeah, actually that's a very good way of conceptualizing it. Exactly, like when it comes to the subscription line, that's exactly what we're saying, that like that if you if you become the de facto limited partner, it hasn't happened yet, but I would love to see what would happen. Then your upside can be as much as 30%, which is a lot of it's a very, very high return in a world of banking where interest rates are really depressed.
Mm-hmm. And so what does the banking system's exposure to alternative investment funds, whether it's vanilla or not, what does that look like in a crisis? Because the way that a lot of academics and risk managers were thinking about this, let's say 3 years ago, was if there's a crisis, who cares? Okay, it's all in the non-banking sector. JP Morgan won't be affected. Citi won't be affected. How does everything we've been talking about change that?
That's a very good question. I do think the way that I can answer this question is that this just tells you that in the next financial crisis, if it involves like these type of activities that has gone wrong, so the implication would be that we are going to see Federal Reserve backstopping the alternative investment funds and private credit funds, because otherwise the spillover into the banking system is going to be too huge to be contained. And so the implication for me would be that, so we're talking about identity, the changes in the identity of banks to become synthetic funds. So the implication for the financial crisis, for the next financial crisis, would be for the Federal Reserve to become the alternative investment fund of, or the lender of last resort in the world of to the alternative investment funds, or the dealer of last resort, depending on how those credit lines or liquidity facilities between banks and alternative investment world is going to be organized or structured. We are going to see the Fed as either a lender or the dealer of last resort to the alternative investment funds. And I do think this is one of the biggest implications for the next or future financial crisis.
And so in the 2008 great financial crisis, the Fed did something it never before did, lending against toxic securities, as well as buying treasury securities and doing quantitative easing and holding them there. The next financial crisis, March 2020, the Fed did even more quantitative easing and unrolled out all of these programs. They had a program to buy high yield bonds. They ended up having to buy vanishingly few of them just because the announcement caused everyone to calm down. But you're saying the next financial crisis, potentially this could be on the table of the Federal Reserve bailing out bank loans to alternative investment funds or alternative investment funds, private credit.
I do actually like a strong. I know that I'm a very conservative person. I usually don't mention any strong, opinion, but I do really strongly believe that we are basically entering the world where we have to expect and we have to be prepared for the Fed to act as the lender or credit provider of last resort to alternative investment funds. I do think, and also like the private corner of that alternative investment funds. I know not just the public one, but the private one. And I think we should become comfortable with that, because that's where the financial system is going. And that's where the Fed is going to be in the next financial crisis.
So I can imagine a lot of our viewers being uncomfortable with you saying that not only is the Federal Reserve going to be, a lender of last resort to private credit, private equity firms, but that actually is a good thing. I might understand that potential pushback, but I would just, for the sake of argument, to agree with you that you either think that like all of this private credit thing is wrong and it should be regulated now, or you think that it's fine and the Fed should be there to clean up the mess. But I think the way of like what can't be right is to allow this to happen, and then if and when there is a financial crisis, to not have there be a Great Depression. That's just right.
That's a very good question. As a matter of fact, like I will answer this question in a different way, because as an intellectual, as someone who loves to learn about the different financial developments and innovations, I love what is happening in the alternative investment world, especially in the private side of it. I think it's very exciting. I think it's very sophisticated. But I don't think it's the question of like whether it's bad or good, or whether it should be regulated or not. As a matter of fact, I might be worried about this. Let's say SEC try to regulate the alternative investment funds, or Fed wants to, let's say, regulate private credit funds at this stage, because I don't think Federal Reserve has a very good understanding of the private credit funds. So I don't want imperfect, or I don't want really like wrong sort of regulation to be imposed on this sector. But what I do think is that for me, the way to think about financial stability and then regulation would be that we have to see this private. So we have to understand how private credit system is growing. This part is easier because we are all interested. We are all trying to. We are all following the news. We are all trying to understand what's behind the news. But it is important to see whether these developments are happening in a market structure that is resilient enough and have enough infrastructures to actually support such development. For example, we were talking about the alternative. We were talking about the private credit ETF, and yes, there are some unknowns in that market that. Like funds such as Apollo, KKR, Citi, and State Street, they are actually kind of like trying to, that are already taking care of it. For example, there are some unknown about how private credit is going to become an ETF, but we do have a very solid firm such as a State Street who have so much experience in ETF who is taking care of this problem. So I am interested to see how the final product looks like, but I'm not worried about the infrastructure and whether we do have an infrastructure to create ETF. We do. A State Street is doing doing it. When it comes to the market making, I'm slightly more worried, but at the same time, we are talking about Apollo, and I'm not worried about the balance sheet size of Apollo, which is one of the important components or determinant of whether you're going to be a good dealer or not. So I do think we have some of the important infrastructures that are required in order to create a good market maker in the private credit ETF. At the same time, the very fact that the price discovery process here is happening without the proper information that is required to do so is something that is very worrisome for me. So the price discovery process is and the infrastructures that are required for that is missing. And that's where I'm very concerned. And if regulators can propose a way to ensure that this discovery process happens in a most efficient way, I think we love more regulation. We want to hear more about regulators. But if regulators are even more clueless than the practitioners, then I think I don't want regulators at this stage to just come and propose some random regulations. So for example, the other important market that right now is missing, and I don't see any really good candidate for proposing an alternative for it or creating this market, is the derivatives. If you want to actually talk about a market structure, one of the important components of market structure for a particular asset, including private credit, is to actually have a derivatives market for it, a market that transfers the risk from one party to another party. We don't have that yet. So I am worried about risk in private credit. But the nature of my worry is that when I look at the infrastructures that are required to make a very a robust market structure in a private credit ETF, some of the infrastructure simply doesn't exist. But some of them, we don't know what the final products will look like or how the final products would be. But we know that it's happening in the strong hands of a State Street when it comes to the ETF creation, or Apollo when it comes to the having enough balance sheet space. And also in terms of the creation, we do have KKR, so we are in a good hand. But we do not have, we do not have a robust derivative market yet. So we do not have a robust risk management mechanism for the secondary market in the ETF, and that worries me. We talked about the market maker, in this case, let's say Apollo. What we don't know is that how this particular market maker is going to finance this market making activities, and what would be the structure or the relationship between Apollo as an ETF market maker and, let's say, JP Morgan of the world as a repo market maker. Is the funding is going to happen through the repo? And if that's the case, what is going to be used as a collateral? What the haircut is going to be? And this is also part of that lack of a price discovery process in the secondary market ETF, which is kind of a source of concern for me. So I want to pause here, but long the story short, what I wanted to say is that I look at this question from a market structure perspective to see which part of market structure we do not have the infrastructure that is required to support this activity.
And so you said the role of a functioning derivatives market. Derivatives can be good, they can be bad. We talked about, in 2006 and 2007, everyone was protecting their portfolios and transferring the risk by buying credit default swaps from one bank would buy from another bank, but that bank would lay off the risk to AIG. And then ultimately AIG was this repository of toxic credit risk that had to be bailed out by the US government to the tune of a lot of money. So what is the derivatives for private credit? Would it be something that I've heard a little bit about within the banking system, a credit linked note where basically a risk transfer, a bank sells the credit risk to a non-bank entity? Would Apollo be selling who would be the issuer of this? Who would be the AIG?
That's an excellent question. So derivatives are imperfect hedging instruments, but they are hedging instruments, and they are still being used as a part of risk management. And so, as a matter of fact, I'm one of those people who think that the role of derivatives have changed. For example, when it comes to interest rate swap, I would say that they are not that much useful for interest rate risk anymore, but they are more useful for creating synthetic funding positions. Or when it comes to and I'm even writing a paper right now. This is at the very, very early stages, but the moral of the story is that the ETFs actually are becoming the new derivatives. They are becoming the new hedging instruments. So I know I'm fully aware of the limitations of the hedging instruments for risk management purposes. At the same time, they are still one of the most sophisticated way of managing risk in the private market. And that's it. And the question, answer your specific question, and I would say that the answer is we don't know who is the AIG of the private credit ETF yet, and that's exactly a manifestation that this infrastructure is missing in the private credit ETF market structure, because not only right now there is no candidate for creating or or offering this type of insurance products to the players in the private credit ETF, including the market maker in the private credit ETF. But there's also not a clear entity right now who can act as such. So there's a whole market that needs to be created from thin air, I would say, because this is very different. Again, I would say that the private credit ETF, the derivatives of the private credit ETFs are going to be different, considerably different from the existing derivatives in the fixed income market even. But this is a manifestation that this infrastructure is missing. And I'm worried about that because we need it.
Yes, I mean credit derivatives are tough. Right?
Yeah, and it's exactly the closest type of derivatives would be like the fixed income derivatives, and they are always amongst the most difficult and the most difficult segments of the market to really manage the risk. So, and the interest rate risk is extremely difficult to manage and understand. And the fixed income market, again, for example, the interest rate swap used to be very, very effective in managing interest rate risk. But because of some of the developments in the interest rate swap, some of the mutual fund managers, those who are actually managing long-term bonds, they are not really able to find the interest rate swap that matches the duration of their fund. And there's this kind of duration mismatch between the interest rate swap that they are holding and the duration of their actual fund. And this is creating so much unhedged risk in the fixed income market. And I'm even talking about mutual funds that are managing US treasuries. So even in the market for US treasury, you cannot really come up with a perfect hedging strategy and using the existing derivatives, fixed income derivatives. So this just shows how complex this market is. And even for a market like US Treasury, we still don't have this perfect hedging market for hedging instruments and market for fixed income derivatives. So that's why I'm very, very concerned about this segment of the secondary market in ETF, in private equity ETF, or secondary market in ETF that's happening through the private equity ETF, because I do think that even in the most well-established and liquid market in the world, we do have a problem of hedging. So my expectation is that it's going to be considerably more difficult to hedge the ETF and private credit ETF. And we don't have anyone who is offering any solution to how to overcome these complexities. And that's a source of concern.
Thank you for that. When I said credit derivatives are tough, hedging credit is tough because it depends on the volatility of the instrument, and credit either performs well. So your people buying credit protection are paying 2% a year, and the people providing credit protection are receiving 2% a year. You either receive 2% a year, or you have to pay out at 100. So your volatility, the notional value of I guess not the notional value, but how much you owe depends so much on how much it's moving, and that's why like interest rates weren't moving at all in 2021, and then they moved a lot in 2022. So hedging, I think hedging is kind of I think the easiest way to hedge is just to not take the risk in the first place. Do you know what I mean?
Yeah, but it's like but it feels like, if you don't wanna if you don't want to hit by the car, don't go outside. I feel like, yes, that's so true. But the whole point, because there's no such a thing as perfect hedge. So so our goal is to kind of like come up with the most efficient hedging a strategy. But what I mentioned about those kind of like duration mismatches, but what fixed income risk managers call duration drift in, let's say, U.S. Treasury market, is that that mismatch that exists between most of the portfolios and the interest rate swaps that are supposed to protect these portfolios, they are not part of this. Okay, you cannot find a perfect hedge, but you have just found the most efficient hedge. That duration drift is there exactly because your hedging strategy, not only it is not perfect, it is not efficient. It's also not efficient. So
sorry, what is duration drift, Elham?
So the duration drift is basically like, simply put, let's say you do have you're a fund manager at PIMCO, and the duration of your fund is, let's say, 10 years, but you manage the interest rate on those funds by entering an interest rate swap that has the highest correlation with the 10-year US Treasury, which is, let's say, 8.5-year interest rate swap. So the idea is that because this is because among the existing interest rate swap instrument, 8.5-year has the highest correlation with the risk that you're undertaking in your portfolio. But if you think about it, at the very end, there is this 1.5-year that is not hedged. So we can think about this in different ways. So ideally, you want to have exactly an interest rate swap that has exactly the same maturity of 10 years. So that's perfect. But maybe in the absence of that perfect hedge, the most efficient hedge would be to hold an interest rate swap that has the maturity of 9.5 years. So in that case, you're not fully hedged, but you're hedged in the most efficient way. But the existing instruments, interest rate swap instruments, have the maturity that is lower than those most efficient hedge that could happen, and mostly because interest rate swap market is kind of like shifting its shape or function from acting as a market to provide efficient fixed income risk management to a market for providing synthetic funding. We can talk about it later if you want, but the point is that in our example, the difference between 8.5-year interest rate swap that you're holding and a 9.5-year interest rate swap that would be the most efficient way of insuring yourself against the risk or hedging yourself against the risk would create what we call the duration drift. And the idea is that the duration drift, which is not about whether you have created a perfect hedge, but it is about whether you have created the most efficient hedge, exists even in the US Treasury market. That just shows how difficult it is. That basically, instead of difficult, I want to rephrase it in another way. That just shows that even in the fixed income market, when it comes to the derivative market, we do not have the best infrastructures possible to support the risks that are actually being shaped or being created in the fixed income market, which is a flaw in the design of fixed income market structure. So when we do have such a flaw, even in the design of US Treasury market structure, then I'm very worried about the fact that we have no idea who and how is going to provide the derivative efficient hedging instruments and proper derivatives for the private credit ETF. And I think I will not take this absence or omission in this market microstructure. I'm worried about that, and I don't think this is a very light omission. I think it's a structural omission, and I'm concerned about that.
Yeah, I think a lot of investment funds like PIMCO, and I'm just going to share this theory with you. I don't know that this is right, but that they own higher yielding instruments that yield much higher than treasuries or agency-backed securities, or somewhat higher, and so they can hedge out the interest rate risk. I feel like for banks, and unlike the private equity, private credit funds, I have gone through a lot of banks and their interest rate exposure. I feel like all of their securities, or most of their securities, are in instruments that have a lot of duration risk, but very little credit risk because of risk weightings. So, for example, Silicon Valley Bank, they own treasuries, and in particular, agency mortgage-backed securities. The risk weighting for treasuries is 0. For agency mortgage-backed securities, it's 20%. And so, when they bought these in 2020 and 2021, the yield on the agency mortgage-backed securities was like 2%. So by taking on a ton of interest rate risk by 2%, and it's negatively convex, so as interest rates rise, the duration expands, which is bad. But for them to, I feel like they would have been better off just buying a shorter duration treasuries than by buying agency mortgage-backed securities and then hedging. Like, there wasn't that much juice there,
I think that was a very good example, and I couldn't agree more. And you elaborated on this point so well. I don't think I do have anything to add, but I totally agree.
Yeah, and I mean, like you write in your paper, which when it comes out, we will share that they had a fair value hedges on available for sale securities of 15.3 billion. I think that means that they didn't have 15.3 billion of hedges. Like, they had 15.3 billion of securities that were hedged, the fair value hedge, and they had over $100 billion in securities. And so, if they kept on that $15 billion hedge, I don't think it would have saved them. So yes, you're right, and everyone's right that it was dumb for them to take off the hedge from 15.3 billion to 563 million. But I don't know if that would have saved them.
Yeah, no, that's a very, very good point. It might not, maybe only the best risk manager in the world, in the history of the world, could save SVB. You're so right. But I would say that is that, it was dumb, or it was stupid for them to kind of drop the hedge at that time. But I just again want to go back to one of the original points that we discussed. But the reason they did is because they had a yield curve or a yield or a swap spread in mind, and they thought that this swap spread is below the market swap spread, and as a result of that, they thought the interest rates are gonna actually the way, and that's how they organized their portfolio of fixed income asset, U.S. Treasury and interest rate swap. And once they started to think that, maybe the Fed is actually going to pause further rather than increasing interest rate, they're gonna actually keep the interest rates lower for a longer period of time. Then at the time they thought, okay, then in this case, the strategy we are at is gonna actually generate so much loss. And it's better to exit this strategy now rather than later. And when the market also realizes what's going on, but then the problem was that most market actually knew what is going on, and it was SVB who was a little bit clueless. The point that I want to emphasize here and make here is that, yes, it was stupid for them to drop the interest rate swap at the time they did, but not because it was bad for risk management. I still don't think that's that was their primary reason for constructing their portfolio of interest rate swap fixed income. But rather it was wrong because they had a very wrong expectation of the shape of the yield curve and what the shape of the yield curve would be. And as a result of that, they actually executed this swap spread strategy in such a failed and in such a failed way, in such a bad way that generated so much loss. So their expectations of the yield curve was the reason. And when they acted based on those expectations is the reason they failed. Again, not because they were not able to manage the risk properly, but they couldn't execute the a strategy that they created properly. They had bad timing.
Yes. And I think maybe if instead of having put money in securities, they put money in the subscription line loans, which have a duration of basically zero, they would have done way better. But the Federal Reserve would never allow that because they had these, the risk ratings would never allow that, right? They had to put them in
I
quote
agree.
unquote safe securities, which were
Safe
unsafe.
securities.
Yeah.
It's just telling you that, technically they put it in the safe securities, but if they are doing it again to execute the complex and risky trading strategies, those safe securities are the biggest source of risk.
Yeah.
And it is in that regard that I think I'm encouraging all of us to think about the concept of safe asset and safe securities in the balance sheet of the banking system from the perspective of this convergence trading strategies, rather than from the perspective of the banking sector who wants to act very safely and therefore is investing in a safe asset.
Yes, and the regulations and the risk ratings of that came after the Great Financial Crisis penalized credit risk, but encourage interest rate risk, and that is very sense because obviously during a credit crisis, nominal interest rates go down, so it's good to take duration risk, and credit risk gets penalized and you get destroyed because no one pays you back because there's a financial crisis. 2022 to now, or 2021 until now, has been an environment where duration risk has been heavily suffering and credit risk has been performing extremely well. So it's just during some environments the risk that you wanted to take in the previous crisis is not the one you want to take in the next crisis. And the current from now 2024 until 2027, it may not look like 2021 till 2024 where not the 10-year goes to 7 or 8% and everyone pays back their loans because there's a ton of inflation. And in that world, Apollo is doing really well, but it's unknowable to know, right?
I totally agree.
Yes. All right. Well, Elham, we've been going for a while, but how about you just leave us with your thoughts on how interest rate swaps can be used to not just hedge positions, but to actually fund this. This is a paper, I don't believe it's out yet, but we'll share it when it's out, but to actually fund it and how it's replacing the repurchase market. You got a paper called Interest Rate Swaps as Synthetic Repos. What is this about?
Thank you, Jack. This is basically based on a research I'm conducting at Jain Family Institute, which is called Market Microstructure Research. And basically, the idea behind this is that I'm very, very interested to learn about the structure of the financial system or market structure from the perspective of practitioners who are actually kind of working on daily basis in this market. But then I put their insights into broader market microstructure and industrial organization theories. So I just wanted to say that there's a program at Jain Family Institute that is based on this idea of connecting practitioners' insight on market structure with the financial theories, especially from the market microstructure in the industrial organization literature. As part of this program, we interviewed one of the biggest trade strategists in Bank of America, and Rolf Axel. And when we discussed with Rolf as a swap dealer, something that I understood is that for Rolf and people like him, clients come to him not necessarily because they want to manage their interest rate risk, but because they do have some, basically, they want to create some funding positions. So they come to him for funding purposes. So that idea or that conversation kind of like created this idea in my mind that maybe there's a reason here. And the reason is the following, that when we look at the financial engineering of interest rate swap, we can actually make the case and a claim that interest rate swap is a derivative, which it is, but the underlying asset is a repo. Meaning, once we look at the cash flow streams of interest rate swap in a slightly different way, those cash flow streams are going to actually replicate a specific type of repo. And it is in that sense that from financial engineering perspective, at least, interest rate swaps are synthetic repo. Okay, so let's talk about this kind of like replication here, because there are different ways of like making the case that the cash flow streams here of interest rate swap replicates that of the repo. But I want to actually walk you through one of the most straightforward cases, and they're at the heart of interest rate swap literature is this concept of comparative advantage. What does that mean? Jack Farleys of the world are the triple A's of the world, and Elhams of the world are the triple B's of the world. So
It's
the
the
truth
opposite.
is,
Thank you.
the truth is, Jack Farley, when he goes to the fixed rate market, he's gonna receive a very favorable rate compared to me, the triple B fund. When he goes to the floating rate market, he's also going to receive a better interest rate. However, the idea behind comparative advantage is the following, that despite the fact that Jack does have absolute advantage in both markets, he does have comparative advantage in the fixed income market. And as a matter of fact, the triple B's of the world, Elhams of the world, do have comparative advantage in the floating rate market. In other words, Jack is doing better compared to Elham in both markets, but he's doing less better in the floating rate market. The other way of thinking about it is that Elham is doing worse in both floating rate and fixed income market or fixed rate market, but she's doing less worse in the floating rate market, and that's what gives me the comparative advantage. So triple B has the comparative advantage in the floating rate market, and triple A has the comparative advantage in the fixed rate market. This is the idea behind interest rate swap market, but I want us to use this fundamental idea at the heart of interest rate swap market to come up to create a cash flow. The very fact that Elham does have a comparative advantage in the floating rate market generates the same financial structure or economic structure as Elham does have more access to the short-term cash market. Elham has extra cash in her balance sheet, in the other words. At the same time, the very fact that Jack does have comparative advantage in the fixed rate market can be interpreted as Jack does have extra access or extra long position in the fixed income bond. So you do have fixed income securities that you want to get rid of because it's extra. And that's why you do have comparative advantage. That's the reason behind your comparative advantage in the fixed income market. And I do have too much access to cash, and that's behind compared to what I want and what is efficient for my portfolio and for my balance sheet. And that's why I do have a comparative advantage in the floating rate market. So me and you, we're gonna meet each other, and through interest rate swap, what we are going to do effectively is for Jack or the AAA of the world is to transfer those excessive or those extra securities, unwanted securities, to BBB, and BBB in return is going to actually send the cash that is extra, or that extra cash that BBB is actually holding, to the AAA, which is Jack. So Jack is sending collateral to me. Me as a BBB agent is sending cash to Jack, and this is repo. This is repo. But the beauty of this repo, this synthetic repo, is the following: that if I want to actually, let's say I'm a hedge fund, I want to create a convergence trading strategy, which is based on, or arbitrage, which we also call it arbitrage strategy, which requires to be funded in, let's say, in a short-term money market, including the repo market, in order to become a complete arbitrage strategy. So for me as an interest rate swap, for me as a hedge fund, if I go to the repo market to actually kind of like create that funding exposure, it is very likely that at some point I have to actually roll over the repo, because I couldn't really find the repo that has exactly the same maturity as my investment in the repo market. This is something that is very likely. Yes, you might be very lucky so that when you go to the repo, you find exactly the maturity you want, but it is very likely that at some point you should consider the repos that is good enough for you now, but then they require you to actually but they need to be rolled over in order to match your investment duration. But what is certain is that these repurchase arguments should be reversed. So this is an extra headache. When it comes to interest rate swap is enabling that hedge fund manager to actually create exactly the same exposure as it would create if it was funding, let's say, having a long position in the US Treasury and funding that US Treasury, long position in the US Treasury in the repo market. Interest rate swap would allow this fund manager to create exactly the same position that includes a funding leg through repo, but synthetically. And the good thing here is that you don't need to roll over the repo, because interest rate swap is not going to be reversed. At the same time, another beauty of this arrangement is that unlike going to the repo market, you are not really kind of like exposed to the haircut. You are not exposed to variation margin, so you are not really exposed to any of that. But because you are using interest rate swap, which does not require like variation margin, which does not require collateral or margin, and which is reducing the liquidity exposures that you are going to have during the life of your investment. They are not going to be interest rate swaps, or don't need to be rolled over, so you don't need to be worried about that. They do not need the collaterals that are required in the repo market, and usually the cost of entering interest rate swap is lower than the cost of repo, especially in the current market environment where the repo dealers are really constrained in terms of their balance sheet because of the regulations. And some of the banks that used to be big market makers in repo, if they are in the repo market, they are usually the one who are borrowing cash, and they prefer not to actually act as a market maker in the repo anymore. That is kind of like creating some sort of like price distortion in the repo market. But the interest rate swap is still a very, very liquid market, and the rates sometimes are more favorable in the interest rate swap. And because the cash flows of interest rate swap are replicating that of repo, it is able to give you exactly the same exposure. So it is in that regard that, and it seems like hedge funds are actually doing that. Whenever they are able to basically replace part of their trading strategies or investment strategies that require short-term funding or repo funding synthetically through interest rate swap, they are actually using the interest rate swap for that particular purposes to synthetically create funding position and funding exposures. And it is in that regard that I am writing a paper about the economics of creating synthetic economic exposures through interest rate swap, and call that paper Interest Rate Swaps as Synthetic Repos. And it is an idea which was generated through a conversation that I had by one of the most brilliant minds in the interest rate swap market. And now that idea is becoming a paper.
And that brilliant mind is Ralph Axel of Bank of America?
Yes.
Okay, great. Well, Elham, so much of that, almost all of that, went way over my head, but and perhaps it went over the head of people listening. But I think if I replay this and re-listen to it, I'll try and make sense of that, and hopefully people can do that as well. So people should stay tuned for your two papers. One is Banks as Synthetic Hedge Funds. The other is Interest Rate Swaps as Synthetic Repos. So your work on the Jain Family Institute can be found at jainfamilyinstitute.org. And you teach at Barnard and Columbia, and you also teach a modern money and banking class at NYU Stern. On Twitter, you are at Elham_Saeidi, and your website is elhamsaeidinezhad.com. Elham, so you're very busy, so I really appreciate you taking multiple hours to speak with me on a Saturday afternoon. Thank you so much.
Thank you so much, Jack. As I said, I learned so much from your podcast and from the way you analyze things. It just helps me become a clear speaker and a more clear thinker as well. So thank you so much for having me, and thank you for this fantastic conversation.
Thank you so much, and thank you everyone for listening. I feel like a lot of the topics we talked about today, they're not just relevant now or relevant 2 years ago. I think they're going to be relevant. I think the merging and the interconnectedness of the banking and the non-banking sector, I would be shocked if a year from now that isn't still relevant or even more relevant. Elham, thanks again. Until next time.
Thank you so much.
Thank you. Just close this door.